Welcome back to the Deep Dive. Today we are digging into General Mills' fiscal 2026 Q2 earnings, which dropped right before the new year on December 17th.
And we're not just, reading off a balance sheet. We're trying to understand the blueprint for how a CPG giant like this tries to navigate a really tricky environment.
Exactly. And our mission today is to unpack this core tension. Why a company would deliberately, and I mean deliberately, sacrifice short-term profit.
And we're talking steep losses, all in the name of winning the long game, rebuilding market share, and getting more volume out the door.
And that long game is all wrapped up in this one word they keep using: remarkability. We need to figure out what that actually means on the shelf.
Right. Where is the money going and is it working? The company's message is pretty clear. They see strong execution. They believe this remarkability focus is improving volume, and they're sticking to their full-year outlook.
It's a huge strategic pivot. And you see just how big it is the second you look at the Q2 financials.
Those are the numbers that really show you the cost of this confidence.
Okay, so let's get into it. The top line numbers, and we're looking at constant currency to strip out any exchange rate noise. Organic net sales growth was down 1%.
Which doesn't sound great, but the metric they really focused on, the win for them, was volume. Organic volume was dead flat, 0%.
And in this environment, flat is the new upright.
It absolutely is. I mean, CPG volumes have been shrinking across the board, so stopping the bleed, just getting to flat, is a massive improvement from Q1. This is all about stabilizing the ship.
So 0% growth is the victory. But that victory came at a pretty dramatic cost when you look further down the P&L.
Oh, yeah. The bottom line is where you feel all the pain from this strategy. Adjusted operating profit growth was down 20%.
20%.
And adjusted diluted EPS, or earnings per share, that was down 21%. And remember, that adjusted number is supposed to be the clean look at their operational health.
A 20% drop for a company of this scale is, it's a huge number, even if it's saw it coming. So what exactly did they say was driving that?
Well, the good news is it was largely planned. They pointed to three things. Number one, and this is the big one, the higher remarkability investments. That's the strategic spending.
Okay.
Second was the impact from selling off their North America yogurt business. And third was something they called trade expense timing.
Trade expense timing sounds like pure corporate jargon. What does that actually mean for us?
It's basically about when they pay the retailers. It's the money for promotions, for good shelf space, for in-store displays. In Q2, more of those bills came due. They're spending more and spending it earlier to make sure their products get seen.
So they're basically paying to play to drive that volume goal.
Exactly. And it's important to know they stressed that even though their Q2 profit was a bit better than the market feared, that's not going to last. They expect that to unwind in Q3. The spending continues.
So this is a planned, sustained investment period, not a one-quarter blip.
That's the critical takeaway. And it all stems from their three main priorities for the fiscal year.
Right. Priority one is the big one. Return North America retail, or NAR, to volume growth. That's their bread and butter, cereal, baking, soup, all of it.
Then number two is to accelerate growth in their North America pet business. And number three is how they pay for it all. Driving efficiencies with what they call holistic margin management, or HMM.
Let's pause on HMM, because if profit is down 20%, this has to be the engine funding everything else. They're targeting 5% of COGS in savings.
Yeah, and that's huge. HMM isn't just about small cuts. It's a deep operational program. They're looking at everything from sourcing ingredients and redesigning packaging to making their supply chain more efficient.
And all that cash they save.
It gets funneled directly back into the remarkability budget. They're recycling savings into growth spending.
So that brings us back to the main concept, remarkable experiences. What does that actually look like when I'm, walking down the grocery aisle?
It boils down to winning on two fronts. Pound share, so the physical amount of product leaving the shelf, and household penetration, getting into more shopping carts.
And they have 5 pillars for how they do that.
Yes. They're investing in superior product, brand communication, package design, what they call compelling value.
Which means managing prices so you don't scare people off.
Exactly. No price cliffs. And finally, omni-channel execution, so being strong online and in-store. It's a full 360-degree attack.
And you can see that spending in the new products they're launching, they're really leaning into the big consumer trends, like protein.
For sure. Look at Cheerios Protein. It's taking a brand everyone knows and trusts and giving it a modern, functional twist.
Or Annie's with that new super. Emma's. I saw it has 15 grams of protein and a good amount of fiber. That's not just for kids.
No, they're trying to pull in adults who might normally grab a protein bar. It's about expanding the use case for a classic product.
They're also fixing those little annoying things which falls under that package design pillar, right?
Absolutely. The new Chex Mix jar with the resealable lid is a perfect example. It's not flashy, but it solves a real consumer problem. No more stale Chex Mix.
I mean, that's genuinely a smart move. And then there's the convenience push with things like Pillsbury's Doughboy Dinners and Mott's snack bars.
It's all about making life easier and removing any reason for a consumer to choose another brand. Usability is key.
And of course, you can't forget the fun, seasonal stuff. The limited time offers that get people to make an impulse buy.
Oh, yeah. The Q3 lineup is packed. You've got Sugar Cookie Toast Crunch, a Mexican hot chocolate version of Cinnamon Toast Crunch.
Plus the Pillsbury reindeer-shaped cookie dough for the holidays.
All of it is designed to get the brand into a shopping cart, even for households that might not normally buy it.
It really feels like North America retail is the segment getting all the attention and all the money.
It is, and the results for NAR really show that trade-off we've been talking about in stark relief.
Okay, so NAR's organic net sales were down 3% in Q2, and segment operating profit was down that steep 21%.
Right. That 21% drop is the direct calculated cost of pushing all this remarkability onto the shelves through promotions and better ingredients.
But the volume side of the equation shows it's working. Nielsen-measured pounds were actually up almost a full percent.
Up 0.8%, and that's a 3-point swing from where they were in the back half of last year. It's a huge turnaround.
And that translated to market share, didn't it?
It really did. They held or grew share in 80% of their top 10 categories. Now get this, in the second half of fiscal 25, that number was only 27%.
Wow, from 27% to 80%. That's a massive jump. But does that just mean they're buying share with deep discounts?
That is the perfect question to ask. And for now, the answer is probably a bit of both. The dollars are lagging the pounds, which means promotions are doing a lot of heavy lifting.
But the hope is that the new products, the better packaging, the actual remarkability will start to stick.
That's the strategy. They believe that gap between pounds and dollars will narrow in the second half of the year as they rely less on deep discounts.
Okay, so if NAR is the big investment project, where are the growth drivers that help pay for it all?
That would be North America Pet and the international business. NA pet sales were up 1%. Profit was still down because of investment, but they held their dollar share in a super competitive market.
And what's working there? Is it the classic Blue Buffalo?
Yeah, the core products like Life Protection Formula are strong, but the real excitement is in cat food with brands like Tastefuls and Tiki Cat, and they're pushing hard into the fresh category with Love Made Fresh.
That's the refrigerated stuff, right?
Exactly. It's a huge priority. They're aiming for 5,000 retail coolers by year end. That's a whole new growth engine for them.
And then international was the real financial bright spot.
Absolutely. Organic net sales up 4%, but segment operating profit was up a massive 30%.
30%? What's driving that?
It's a mix of pricing that's holding up well and real market share gains, especially in France and Mexico, where they've really tailored their strategy to local tastes.
Okay, so we've covered the strategy, the cost, and the segments. Let's circle back to how they're funding all this. The HMM cost savings.
Right, that 5% of cost of goods sold target, that is the fuel. It's an industry-leading productivity number, and it gives them the cash to keep investing in the brands even while taking a quarterly profit hit.
Which explains why, despite all this red ink on the quarterly profit line, they are standing firm on their full-year guidance. They're reaffirming their outlook.
It signals a ton of confidence that this volume recovery plan is working and is sustainable. They're sticking to it. They're guiding for the full year to have organic net sales between -1% and +1%.
And the profit numbers.
Both adjusted operating profit and adjusted diluted EPS are forecast to be down for the year, somewhere in the range of -15% to -10%.
And the -10% to 50% is the full-year cost of this strategy.
Yeah.
But they also pointed out a couple of other headwinds baked into that number.
They did. About 5% of that headwind comes from the net impact of acquisitions and divestitures. Another 3% is from a normalization of corporate incentive pay.
So you've got about 8 points of structural headwinds before you even get to the massive marketing spend.
Exactly. When you add it all up, you see why the profit guidance is where it is. It's all part of the long-term plan.
So boiling it all down, the key takeaway for you watching this space is that General Mills seems to be successfully stabilizing its volume. They're using this remarkability strategy, this intense brand investment, to get into more households.
And they are fully accepting a steep but temporary hit to their quarterly profits as the strategic cost of doing business to secure that long-term relevance.
It's the price of shifting from a market focused on price hikes to one that demands real volume and value.
And, they've done a great job executing on what they can control internally, but they can't control everything. In their forward-looking statements, they list all the usual risks: tariffs, supply chains, competition.
Right.
But they listed one that could change everything: changes in consumer behavior and preferences, including weight loss trends. So here's the thought I want to leave you with. Given that this whole remarkability strategy depends on selling more cereal, more baking mixes, more snacks, if these new weight loss drugs fundamentally change how a huge portion of the population eats, does a better Chex Mix lid even matter? Of all those external threats, from supply chains to consumer diets, which one do you think is the biggest wild card that could derail this entire carefully planned strategy?
A crucial question to think about. Thank you for joining us for this deep dive. We'll catch you next time.